Welcome to a webinar on how to help your kids get into the housing market. Think about your own home. What would your kids need to buy that house today? Well, the reality is we bought it a few years ago, sometimes a lot of years ago, and your kids will need a higher down payment. They will need more income stability. They will need more stable income, and they will need better credit. Here's the second house I ever bought. Um, If we bought this for $400,000, that's a way cheaper price than it would be today. This home today would cost over $1.2 million. And check out that sweet interest rate we got, 4.99%, right? So interest rates are also much lower today. This mortgage actually cost us $2,124 a month when we bought this house. And we rented an illegal basement apartment in it for $1,500 a month so that we could afford it. So it's not super expensive living. It was actually much cheaper than rent. What I want you to look at is how much the home went up each time it was sold. So can you imagine how much overtime your kids would have to work to make an extra $100,000 in 2 years? Or what about $650,000 in 12 years? We can all agree that homes go up over time, right? So let's look at this house, right? It's $1.2 million today. So if my kids wanted to buy that house today, here's what they would need. They would need $240,000 for a minimum down payment. That is $219,903 more than I needed to buy that house in 2008. $192,000 in income to qualify. So in 2008, we only needed $76,000 between me and my husband to qualify for that home. Now you need $192,000. We could also use that basement apartment, that illegal rent. Not all lenders will use that today. Only a few would actually take rent from that basement apartment that we had. Many of them want to see it to be legal these days. And something else that's just kind of interesting is that that was our second house. We could actually refinance our first house up to 95% of the value and pull out the money to buy that one. Now the limit's only 80%. Why is that important? Well, your kids don't have a house to sell, but it's very important for you to understand that there's been 60 major mortgage regulation changes since 2008. And this is definitely not the market that you or I bought our first home in. Things have changed a lot. Fortunately, you've tuned into this webinar, so you're going to learn about that today. And who are you learning from? Well, who am I anyways? I'm an experienced mortgage broker with hundreds of happy clients that can attest to our service, knowledge, and advice. We have also won a ton of awards in the industry, which supports the idea that we're actually really good at what we do. More importantly, I have 3 kids. And I think about protecting them and getting them into the market all the time. And that's kind of my driving force for why I want to help you today. A lot of parents really want to help their kids. They just don't know how or what options are available. And I find people aren't always really good at explaining them to you. Okay, it's important for you to also know that we work with 57 different lenders as mortgage brokers, and they pay us to provide customer service on their behalf. Our clients do not pay for our service. Also, that this presentation is not based on one particular lender's guidelines or policies. The products, what their preferences are, they all change. This is based on the mortgage market as a whole and the options that we have across a whole bunch of lenders. Because choice is really important and how we structure these things is really important. So let's jump right into it. What are we talking about today? Well, 2 things we're going to address here are ways that you can help your kids and ways that you can protect yourself. Okay, so let's start with how we can help our kids. We can buy an investment property, we can gift down payment, or we can be a cosigner or a guarantor. Okay, so buying an investment property. So this is where I'm at right now. My kids are small, and I want to ensure that we're in a position financially to help them in the future. As a result, we own rental properties that tenants cover the mortgage and expenses, and they will go up in value over time. Those rentals could be sold or refinanced in the future to pay for university or gift a down payment for my kids. Or maybe they're sold to the kids so that they can actually become their first home in the future. Um, Remember, houses go up in value over time. Think about how much equity is sitting in your home right now. If you had two, what could you do with that? I mean, maybe it's not helping the kids. Maybe it's that we could sell the rental in the future, pay off our mortgage on our primary residence, and be mortgage free so that we could better financially help our kids in the future. Who knows? But owning an investment property actually opens a lot of options that aren't there if you don't have one. If this strategy is something you would like to consider, I have another presentation that I can actually send you so you can reach out to me and just ask me about the investment property presentation, and I can send you that. So let's look at gifted down payment. So there are pros and cons to each source of gifting a down payment from different sources. So a reverse mortgage, the pros are going to be that there's no payments at all. The con is that it's a higher interest rate, and also that you have to be a certain age, have a certain amount of equity in your home. So sometimes you don't really qualify for as much as you think you do in that product. Um, a refinance or a secured line of credit. So the pro to these right now is that the interest rates are a lot lower, right? We're at record low interest rates. And a line of credit is actually an interest only payment. So that can save you a monthly fee, or, if the kids are paying it, a monthly fee. The con is going to be that you're taking on debt and it will impact your ability to qualify for something in the future. If we're looking at savings, the pro is going to be that obviously it's your money, so there's not going to be any payments on that. The con is the opportunity cost of that money. So, especially right now, what would that money make for you if you kept it invested? And also, it's important to consider, will there be a tax event if you pull that money out, right? If it's in an RSP or something, is it going to have you costing money in taxes as well? So cosigners versus guarantors. So many people get these confused. A cosigner is typically the arrangement we see the most in the GTA where parents' available income is being used to help the child qualify higher, right? Usually we're adding you to a mortgage because your kids need help qualifying. Maybe they're part-time, maybe they don't have stable income yet, they're a contractor, they're self-employed, and it's a new business. Things like that don't really have them qualifying on the stress test the same way as they would if they had more stable or higher income. Remember that stress test, like they have to show that they can afford a mortgage over 5%. The interest rate that they're getting is less than 2%, but they have to show they can qualify for over 5. So sometimes a lot of people are having a little bit of issue with the stress test and need their parents' income to help. A guarantor is another option. It is more for credit support. So if there are issues with the credit, missed payments, low credit scores, lack of credit, sometimes we need a guarantor in those situations. Those ones don't always have to go on title depending on the lender, but with the cosigners, typically you are on title because your income is being used to qualify for the mortgage. Okay, let's talk about ways to protect yourself. So, picking the right product, how the ownership is structured, accounting, and other items that you need to discuss. So, picking the right mortgage product. I will tell you right now that I almost never place a mortgage with a cosigner at a fixed rate mortgage at one of our big five banks due to the high penalties. Our big banks use posted rates to calculate what's called the interest rate differential penalty, making it significantly higher than many other A lenders in Canada to break those mortgages. When we have a cosigner on title, it is more likely than we are going to break a mortgage, and the average in Canada is about 70% of people break their mortgage early. So that's more than a passing grade. It is likely to happen. And the truth is, if you're co-signing for your kids, you want to be off title as soon as you can, and they want to be off title as soon as they can get you off. So it's really important that we structure it so that you have a mortgage that has the cheapest penalty possible. We almost always suggest a variable rate mortgage for co-signers, as most of them are in only 3 months interest penalty to break that mortgage. The issue with it being at a big bank is that if there is a temptation to lock in fixed rates as the interest rates go up, then that penalty goes back to that posted rate calculation I just mentioned. So for the most part, we typically will place co-signed mortgages with either fixed rates or variable rates, but preferably variable at online lenders or lenders who do not use a posted rate to calculate their penalty. Okay, what is a trust agreement? So, most people will choose to have their lawyer set up something called a trust agreement. It is basically a document that you do at closing that says to CRA, this is not an investment property. This is not a house that I'm making money off of. And therefore, CRA will look at that and say, okay, then it's going to be capital gains exempt. Why is this important? Well, remember that house I showed you earlier? We actually paid $34,000 in capital gains because we did not have any sort of agreement like that, but also because our accountant screwed up. And it was our primary residence and it should have been tax exempt. Um, but the thing is, you have to have a really good accountant who's experienced with rental income and how to claim it or how to not claim it, where to put it or not put it on your T1 generals so that you can ensure that these things do not happen to you, right? I put on the slide there. Learn from my mistakes instead of learning the hard way like I do. If you need a good accountant or some recommendations, we know quite a few who are really good at what they do, and we'll make sure that they're not triggering any sort of tax event that shouldn't be there if you are to go on title of your child's home. What other discussions do you need to have? Well, the thing is, we need to talk a little bit about the future. You need to sit down and talk to your kids about, do they have a partner? Or what if they get a partner? If that person becomes common law partner, do they have rights to the house? What if they do have a partner and they separate or divorce? What happens then? What if they damage a property? What if you pass away? So if they need your income to qualify for that mortgage and you are no longer there, do you have enough life insurance to pay that mortgage out? Or are they on the hook for a mortgage they can't qualify for? What happens there? Is there somebody else that can co-sign for them? Or do they need to sell their house very quickly? What if they miss mortgage payments or they can't afford the home? And how does that impact you? Because it will go on your credit bureau if you are a cosigner. So it's an important discussion to have. And do you have limited time to help? Do you have other kids that you need to help later? Do you have a cottage you want to qualify for? Are you retiring soon? Like, are there situations where you can help, but only for a certain amount of time? So how can you help your kids now and when they're ready? Well, it's important that you teach them about credit. We have a lot of information about credit and how to build it properly. Good credit will allow you to access the best interest rates available in Canada. So it's really important that they start early and they build it properly. Living on cash and not having any credit is not a good option. Lenders need to see a history of borrowing money and paying it back successfully so that they will be willing to give them hundreds of thousands of dollars of their own money. You can help them save a down payment, teach them how to save. You can teach them about home ownership in general, right? Yeah, we're talking about mortgages here and we talk about mortgages all the time, but what are other expenses? Teach them about how much renovations cost or what it costs to fix a furnace when it breaks or how much a new roof costs when you need that, right? Regular maintenance costs. They need to understand what they're getting into beyond just the mortgage payment. And lastly, get them pre-approved properly. Do not do online calculators. Do not do, just randomly walk into the teller at your bank and ask them questions about mortgages when they may or may not even own a home themselves or have, how many mortgages do they do in a day? You don't know. Please make sure they get pre-approved properly with a credible and qualified source. If you need help with that, we obviously do that all day, every day. Beware of the 3 Fs of fraudsters, fees, and fake offers. So if something sounds too good to be true online, it probably is. And kids are hanging out online more than ever for this information. But remember those 60 major mortgage regulation changes that we talked about? Well, the thing is, a lot of that information is outdated online. I can go right now and find information about down payment that's not correct online. Google is not always our friend when people get busy and forget to delete old information that is no longer relevant. What do I mean by that? Well, what's the biggest outdated comment I hear from first-time buyers that they are told by their parents? I want my kids to avoid paying CMHC, right? So I want my kids to make sure that they save 20% so that they avoid those CMHC. And that makes sense in theory because who wants to pay more insurance than they have to? But the reality is in 2016, the changes that were made to the mortgage market and how things work is that now anybody who has less than 20% down, yes, they have to pay CMHC, Canada Guarantee, or Sagen default premiums, but they also get lower interest rates. So they get access to lower interest rates, which can sometimes save them more than that penalty or than that default insurance. Often it's the case that we have people who have 20% down and we do the math and they choose to put 19% down or less so that they can save more money because they save more interest over time. Those people are also offered better interest rates at the end of their mortgage term because it's still an insured transaction. So something to be aware of is that again, this market is not the same market I bought my first house in or my second house or even my third house. I can assume that is probably the same for you as well. So if you have any questions, feel free to book a call at laframboisemortgage.ca. We'll talk to anybody. We'll help you through it. We're happy to do a chat about how all of this works or look at all those options, right? Can we gift a down payment? Can we pull equity from your home to help your kids? Or is co-signing a better option for you? We would love to help you and help your kids get them into the market faster because we all know interest rates are going up and home prices are going up too. So let's get them in before it's too late and get them self-sufficient sooner. Thank you so much for your time today, and I hope to connect with you soon.